Hello, and welcome to today's webinar. My name is Jacqueline Dorsey of Lean Frontiers, and I'll serve as your host today. I'm excited to bring to you today a short webinar on lean accounting facilitated by Michele Nash-Hoff. Michele is founder and president of Electrofab Sales, a sales agency specializing in helping manufacturers select the right processes for their products since 1985. Due to our limited time for this webinar, we will not be doing a Q&A session. Also, this will be recorded if you want to refer back to it later. So for now, let me turn things over to Michele.
Good morning. Hello. For the last 25 years, American manufacturers have been outsourcing manufacturing offshore. And from 2000 to 2011, the U.S. lost 5.8 million manufacturing jobs and 57,000 manufacturing firms closed. Where did these jobs go? Well, according to data from the U.S. Department of Commerce, U.S. multinational corporations cut their workforces in the U.S. by 2.9 million during the 2000s, while increasing employment overseas by 2.4 million. So we can see that nearly half of those jobs that were lost in the U.S. went offshore. So what were the consequences of this offshoring? Well, the recession that we had starting in the end of 2007, we've had very slow economic growth after the Great Recession ended. In fact, our growth has been, no higher than 2% in those 8 years now. We've had federal and state budget deficits that have reached record levels. We've had high unemployment in contrast to what the U3 report says of like 4.8%. The actual unemployment, when you include all the people that are off the unemployment rolls or just having part-time jobs, is really closer to 10%. We have a shrinking middle class. We have declining innovation because when you separate design from manufacturing, you don't have the know-how to generate the next generation of a product. You need to keep design and manufacturing near each other to be synergistic. And then you have a lack of recovery in the home construction industry because fewer people can afford to buy homes, and we have had really no recovery in employment in the construction industry. How can we return more manufacturing to the U.S.? Well, there's several ways. One way is to use some of the new software programs for design for manufacturing and assembly. One of them is by Freud and Dewhurst. You can learn and implement Lean Six Sigma tools, especially Lean accounting. You can help customers and prospects understand total cost of ownership. And then there are things that we don't have control over, such as the government needs to address the corporate tax rates and the value-added taxes that other countries add to our exports when we are exporting American products to about 159 other countries that add value-added taxes. The other thing is we need to develop a larger skilled workforce. So the reality is here in the United States that about 60% of manufacturers only apply rudimentary total cost models. They ignore 20% or more of the total cost of offshore products. When the Archstone did this survey back in 2009, even then 51% of companies found no financial benefit in offshoring. They had sort of followed the herd mentality of if we should go to China like everybody else. So what is total cost of ownership? It's an estimate of direct and indirect costs. The 13th edition of APEX, which is the Supply Chain Professional Organization, their dictionary says, in supply chain management, the total cost of ownership of the supply delivery system is the sum of all the costs associated with every activity of the supply stream. However, most companies don't look beyond the quoted unit price when they make the decision of where to source. I've actually lost orders for less than $1,000, where one trip to China will cost double that round trip. So doesn't make sense sometimes. So what are some of the hidden costs of outsourcing offshore that we need to take into consideration? Well, first of all, there's currency fluctuations. So your $1,000 invoice, when you generate it, could be a different amount when you actually go to pay it. There's always more difficulty in managing an offshore contract than is expected, both in time and money. And then you lack the ability to make rapid design changes because you're dealing with a vendor that's halfway across the world, and you don't have that synergy between your engineers being able to try something out and go try it on the shop floor in a prototype and then see if it works. Then you have quality problems where you can get in parts that are defective and they have to be reworked or sent back for replacement. Then you have legal liability because if you have a warranty on your product, you don't know whether your product is also going out the back door from the vendor into the gray market where people are buying your product not really from you, but on the gray market, but because you have to honor the warranty on your product. Of course, there's travel expenses for trips you have to take to that country. And then there is the time and effort to make a transition from transferring manufacturing from here in the United States to the offshore vendor. It always takes more time and effort than you anticipate that you are going to experience. And even though we have the internet now and Skype, you still have a problem with communication because you're dealing with people where English is their second language. But the biggest problem is in intellectual property infringement because China does not honor our patents. They steal our technology. The vendor you select may be also making your product out, selling it out the back door under their name or another name. Then there's the cost of inventory because in order to get that China price, you usually have to buy a higher lot size than you would have bought from your American vendor, getting things just in time. And you have to wait for that flow boat from China, so you have to have a higher safety stock, which then costs money to buy more parts and takes more space to store the parts. So those are some of the hidden costs of doing business offshore. Well, what's happened since 2008? Between 2008 and 2013, we actually saw oil prices triple, which raised logistics costs, and the cost of the container went up triple. But now that we have the glut of oil in the last year and a half from Middle Eastern companies trying to destroy our American fracking companies and natural gas industry, we have lower costs. But the costs have not really gone back as low as they were because after the recession, all the major shipping lines cut the number of shipping routes and cut the number of ships per route because it never got back up to quite what it was before the recession on the worldwide basis. Another factor is labor rates in China have risen 800% since 2007. Component and material prices have increased, and the U.S. has become more productive from automation and also the implementation of lean. Then there's political instability in China. Most people don't know about it, but if you get on blogs like chinablog.com, you find out that in China there's actually what we would call demonstrations and they call riots going on every week. It's illegal to demonstrate or have a strike in China, but people are actually demonstrating and striking because of the pollution that's been caused by the manufacturers, and the people are realizing that the pollution is actually killing themselves and their children. It shows here the index between the costs of U.S., Germany, China, Mexico, and Brazil. You can see that the U.S. has stayed pretty flat. Mexico has been up and down a little bit, but look at the line for China; it's way up. And so that's some of the factors that have gone on for it here. So back in 2011, the Boston Consulting Group released a report where they predicted that we expect net labor costs for manufacturing in China and the U.S. to converge by around 2015. This was very controversial when this came out 5 years ago. People really thought it was not going to be possible. And they recommended that companies need to take a hard look at the total cost. If labor is 20 to 30% of unit cost, China's prices will be only 30% below U.S. level, and the savings will be exceeded by other offshoring costs. They predicted that there were 7 industries that had reached tipping point of returning to the U.S. Transportation goods, electrical equipment, appliances, furniture, fabricated metal products, plastics and rubber products, and computer and electronics. These sectors account for 70% of U.S. imports and $2 trillion in U.S. consumption. So in 2010, the Reshoring Initiative was started by Harry Mosier. He had been president of GFAG Charmy in 2000 for 25 years, and they funded him to start this organization. And he developed a total cost of ownership worksheet calculator to calculate the hidden costs on doing business. It has become a nonprofit organization that has about 35 major sponsors shown on these next 2 screens. And he started collecting stories about companies that were reshoring, that were using his total cost of ownership calculator. It's free. You can get it on his website, reshorenow.org. And the purpose was to train OEMs on why to source local and how to use a TCO calculator, and suppliers on how to sell local sourcing. It provides an online library of about 3,000 reshoring articles, and has a template for you to post your case for a successful reshoring. Here's what the entry-level page looks like now, where you're giving some information, and you can say whether it's a real case or you're experimenting. I couldn't take screenshots of the whole thing because it would just take up too much time. So let's see an example. Here we have a part that in the U.S. the unit price cost is $100. The Chinese unit price is $70. But you actually calculate, this is some of the information you put into the worksheet, where you calculate the number of units per year, the unit weight, how many shipments you're going to have per year, the estimated product life, the cost of the packaging, whether you have to pay on shipment or on invoice, a quality cost that you can quantify, product liability risk, intellectual property risk, innovation, how many trips per year you're going to make, the prototype cost, and a sort of a very hard to calculate variables, but it has drop-down menus so you can choose these by country. So it calculates the political instability risk, wage inflation, annual estimate for that particular country, and the currency appreciation. So using this data that you put in there, then the TCO calculator calculates the total cost. And showing this chart with the sample part, you can see that the difference between the China and U.S. price is reduced to only a few dollars, and by the 3rd year, the price is equal, and then even lower by the 5th year. So when you only use purchase price variance, you are actually not calculating about 23% of the total cost. If you use the landed cost that includes your shipping and logistic costs, you're still skipping about 13%. So only by using the total cost of ownership calculator can you actually be calculating, the total cost in comparison to another country's total cost. And it has, you can select the country that you're comparing. It doesn't just have China. So the interest in reshoring from production in the U.S. remains strong. And this shows the difference from 2012 to 2015. So you have an increase in nearly all the categories where there's companies that are considering doing it right in the near future, that are actively considering it but haven't made a final decision, and made the decision to, yes, we will move production to the U.S., or that we're already doing it. So here's some of the main reasons why companies are returning back. Shorten their supply chain, reduce their shipping costs, be closer to customers, access skilled workforce and talent, make it easier to do business, and provide local control over manufacturing processes, improve quality and yield, and accelerate innovation and product development. So these reasons fall into, three main categories of reasons. So how do you select the first parts and products to consider reshoring? Well, the number one reason, of course, is intellectual property at risk. Number two is labor content. If your product has less than 30% labor content, you probably shouldn't have even offshored in the first place, but it's definitely where you need to start with. If you're having problems with quality, where you have a lot of rework or defective parts that you have to send back, if your lead time is too long, so you can't do fast turnaround to your customers to meet their needs, and you're losing orders because you can't satisfy your customers. If your minimum purchase lot size is too large, so that you're having to have a higher safety stock, which increases your inventory cost and increases your cost of the space for the inventory. And if you have large, heavy, or bulky parts that are costly to ship, or your product design results in shipping too much air. Think of a hula hoop. There's a lot of air in a hula hoop, and it was filling containers full of air, and which is why Whammo brought hula hoop back, already a few years ago. So here's some of the reshorers that just in the last few years, you can see some major companies like Caterpillar and General Electric and other major companies that have brought products back. So General Electric is one of the first stories that got written about in great depth. They first brought back a water heater, and they redesigned the product and made it simpler to assemble. They used the design to manufacturing software and eliminated some parts. So that was the first thing. But now, since then, they have brought back refrigerators and washing machines to their unionized facility in Louisville, Kentucky. And I had the pleasure of visiting Plant Spark last summer. And they have a renovated factory, and they have created 1,300 jobs. So it's first-time products were brought back in nearly 10 years of not having any manufacturing in Plant Spark, Kentucky. They did get some tax incentives locally. They reduced their retail price by 20%, and they are planning to move even more appliances back to Plant Spark, Kentucky. NCR brought their ATMs back from China, India, and Brazil to Columbus, Georgia, in a 350,000 square foot factory with 900 employees. The reasons were slow response from contract suppliers, especially lower tiers, because China wages were up, and they now have manufacturing, their engineering, and customers. This Sleek Audio brought high-end earphones back from China to Manatee County, Florida. Their reasons were they were having too much scrap, they were losing sales, they often had to use emergency air freight, their costs were up, and then communication problems of language and time, having someone have to be available for calls at 11 p.m. our time. Billy Cop, paper and plastic food service goods, they reshored from Asia to Chino, California, 2013. They added employees once their new facility was completed. Their reasons were to shorten lead time, reduce shipping costs, have increased, proximity to customer demand, patriotism, quality, and the fact that they automated their factory. Walmart has a program they've announced in 2014. They plan to spend $250 billion over 10 years for U.S. manufactured purchases, which would create about 300,000 manufacturing jobs by the 10th year, which, because of the multiplier effect of 3 to 4 manufacturing jobs create other support jobs, that would be about 1 million total jobs. Their purpose is to increase what we buy in U.S. manufactured goods, source new to Walmart manufactured goods, and reshore manufacturing of goods they currently buy. So the bleeding has stopped. Back in 2003, we had about 150,000 new offshoring cases per year. By 2013, it was down to 30 to 50,000. By 2016, now it's estimated to only be about 20,000. We have a lot, new reshoring has gone up about 1,500%, and net reshoring has definitely increased. We've had a job growth of about 500 to 600,000 now since 2010, of which about 15% is reshoring. So you can see jobs reshored by states that the Reshoring Initiative has been able to capture the case studies. Notice the ones in red, those states, California, Michigan, New York. Those are high cost of manufacturing states, and yet they have been able to have reshoring done. In fact, California has the most cases at 34, but because the average size manufacturing company is smaller than other parts of the country, the number of jobs per facility is low. About 95% of manufacturers in California are under 100 people. So the potential reshoring benefits are that we could eliminate the trade deficits that average between 500 and 600 billion a year. We could add 3 million manufacturing jobs, which, because of the multiplier effect, would be about 9 to 12 million total jobs. We could reduce the real unemployment, the U6 figure, down to about 4%. We could cut the U.S. budget deficit by about 50% and have about a 25% increase in manufacturing nationwide, which is spread over 25 years, would result in 25% extra annual capital equipment investment, which in turn would create more manufacturing for the companies to produce that kind of equipment. So what can you do? Well, you can use the TCO calculator, free at reshorenow.org. You can use the library to check out other cases, and you can watch webinars that they have already recorded. You could work with groups being trained on TCO, which are the Manufacturing Extension Program organizations funded by the U.S. government. If you do reshore, you can submit cases of reshoring for publication and posting. You can prepare your company's workforce for reshoring and encourage your company to sponsor the Reshoring Initiative. So thank you very much for listening to my webinar, and sorry that I had problems with my computer.
All right. Well, Michele, thank you for facilitating our session today. So to wrap up, I just wanted to remind you all that today's webinar is being recorded. So look for an email following our time together for a link to the recording. Feel free to share this throughout your organization. So again, thank you, Michele.